Listen, the one thing we never hear in our coaching appointments is, man, I just saved too much money for retirement. I want you to be the first one to be able to say it. Well, welcome to the Money Tip Podcast presented by Fully Funded Life. My name is Joe Sengel. Hope you've had a great start to your year. And today I want to talk about something that's very relevant to the start of this year, being able to contribute to retirement plans. You know, every single year, the government has systems in place that adjust based on cost of living, inflation, and various other inputs, plus past law that changes the amount of money that you and I are allowed to contribute to retirement accounts and the like. Today, we're going to talk about those adjustments. And I think the off the top moment is, number one, are you contributing to an available retirement account? Are you contributing anything to your available 401k, 403b, 457, TSP? If you're in Canada, that RSP, that TFSA, that Roth IRA, or that regular IRA. Are you contributing? Because the only number that will positively not grow is a big old zero. It rhymes if you say it like that. And I want to make sure you're living a fully funded life, and it's going to be impossible to be able to do so if you do not have your money working for you. And so this is wildly important. And today we're going to talk about the limits, the maximum that you're able to contribute to those things, and the changes that have been made from 2023 to 2024. Now, in a minute, I'm going to share those numbers, and we're going to also have them on the screen if you're watching on YouTube. But here's what I want you to think about before I share the numbers for 2024 is you are still able to contribute to your 401k, your regular IRA and Roth IRA up to tax filing day of April 15th, 2024 for the year 2023. So if you got behind, forgot about it, but you had the money that you were planning to invest for last year, you can still do that and get it credited toward last year's contribution, which would allow you to still contribute this year's later on this year. So that's really important to think about through the tax filing day of April 15th. Now, the 2024 limits, let's talk about it. The 401k, they have increased the max you can contribute to $23,000. Yes, $23,000. And if you're age 50 or older, you can do catch-up contributions of additional $7,500. That means $30,500. So if you're 50 or turning 50, like yours truly is this year, it's going to be a half century old. Can you believe it? That went fast. I remember a great song by Bill Gaither, the Southern gospel great. He sang a funny song that said, I thought getting old would take a lot longer than it did. It's a great, funny song. You can watch that on YouTube. But that means if you're my age or older, you can contribute $30,500 to a 401k this year. That's a big deal. Now, I also want you to know that if you are contributing to an IRA, whether a traditional IRA or Roth IRA, this year in 2024, you can contribute $7,000. Okay, $7,000. And if you are my age or older, 50 or older in this calendar year of 2024, you can do catch-up contributions of an extra $1,000, making it a total of $8,000 for the year. This is really important to think about. Now, many people, maybe you're one of those that is just starting in your money journey. You're on rung number 3 of the ladder. You're doing good to just contribute enough to get the company match or $100 a month, whichever is greater. That's what rung number 3 of the fully funded life ladder is about. And you're like, who in the world can contribute, $23,000 to a 401k or $7,000 to a IRA or Roth IRA? Well, I want you to think about as you apply the principles we teach, you're preparing that budget every single month, you're forming that good habit, you're saying no to new debt, you're paying off existing debt. And let's say you free up a car payment of $500 a month. Well, very quickly, you can get to be able to hit that maximum limit of that IRA. that car payment of $500 a month looks mysteriously like $6,000 for a year. That's really close to that $7,000. And many people who are my age or older, they start experiencing empty nests. And those beloved children go on their own payroll and get off of the family payroll. I've got one of my 3 off the family payroll. Got 2 more to go. But as you do that, that frees up cash. Plus, hopefully you're in those power earning years and you're producing more income. You're able to start really socking it away towards retirement. Of course, the earlier you can get to maximum contributions, the better. And that's why we really focus on becoming debt free, that rung number 4 of the ladder, with everything except for the house and business debt, becoming debt free. And then on rung number 7, paying off that house and business debt. But I want you to think about how much you are contributing right now and whether or not it makes sense for you to increase your contributions in lieu and in light of where you're at on the ladder and what your plans, hopes, and dreams are dictating to you. Okay. Now, it's important for us to talk about another thing that in the United States is called the hidden Roth IRA, and that is a health savings account. Now, a health savings account is different than a healthcare reimbursement account or flexible spending account where you contribute dollars there tax-free, but it's a use it or lose it. You have to use it within that year or you lose those dollars. A health savings account is attached to a high deductible health plan as defined by the federal government. And if you have a qualifying high deductible health plan, you are able to have a health savings account. That money can be placed within a bank. It can be placed within a CD. You can even invest some of those dollars. I do have a high deductible healthcare plan, and I have a health savings account with HSA Bank, and they have a partnership with Schwab, and that allows me to invest those dollars. Here's something important to note. If you are able to contribute to the health savings account, you are allowed to contribute $4,150 in 2024 for a single person, an individual, as long as you have a minimum deductible of $1,600 on that high deductible healthcare plan. And you can double that, $8,300, if you have family insurance with a minimum deductible of $3,200. That money, if you invest it and you do not use it, you choose to go ahead and contribute to the health savings account, invest it. It's tax-free going in. It grows tax-free. At age 65, money in an HSA is no longer required to be used for medical expenditures. That's a big deal. So I contribute to my HSA, I invest those dollars, and I take the challenging step of attempting to pay for all of my medical bills out of pocket separately. Why? Because I want to be able to use these dollars in the HSA for retirement at some later date in the future. And so that is an important thing to note. That's a big increase from last year. Now, of course, there are income restrictions for the Roth IRA, something called the modified adjusted gross income phase-out range. And the income phase-out range for taxpayers who are able to make a contribution to Roth IRA, it is increased in 2024 to between $146,000 and $161,000 for singles and those filing head of household. And that's up from $138,000 to $153,000 as a phase-out period. It's an increase of $8,000 on that lower and higher limit. Now, if you file jointly, filing jointly, that income phase-out range has been increased to $230,000 to $240,000. That's up $12,000 on those two ranges. Okay. So as long as you're making less than that for your modified adjusted gross income, you can contribute to a Roth IRA. And so that's something really important. Now, for a traditional IRA, the numbers are different. That range is between $77,000 and $87,000 for those filing individually or head of household. And for married couples, it is $123,000 to $143,000. What is a phase-out range? A phase-out range is, hey, if you make, let's say you're married filing jointly and you make $125,000. Well, that's in that $123,000 to $143,000. You can still contribute to a regular IRA. You just have to reduce how much your limit. You can't hit the maximum. As you get to 143,000, you're no longer able to contribute to it in a tax advantage manner. Now, it's something really important to think about is that April 15th deadline. We're sharing this in January of 2024. April 15th will be here before you know it, but it gives you that 3-month period or so for you to be thinking about how much you want to contribute in this year. Do you want to do catch-up contributions for last year? And make sure that you use this to position yourself to be successful, not only this year, but to fund those big plans, hopes, and dreams that define and comprise your fully funded life in the future. Hey, we're so excited to be able to serve you each and every week with right now relevant information. What could be more right now relevant at the start of the year here to be talking about maximum contributions and being able to put your money to work for you. And so I encourage you, take a look at these limits. Which ones apply to you? Do you need to increase your contributions? Listen, the one thing we never hear in our coaching appointments is, man, I just saved too much money for retirement. I want you to be the first one to be able to say it. The only way you'll get there is by maximizing contributions today. Hey, have a great week and go live your fully funded life. Hey everyone, Joe Sangle here. Thanks so much for watching this episode. Hey, I encourage you to check out our other videos that are available here. If you like this, hey, every single week we're producing new content that is to help you with right now relevant information. So make sure you click one of the links and check out some more of our information. I think you'll be so glad that you did. I know your wallet will be glad you did.